Welcome to the online training series and the unit on third-party risk management. My name is Dana Bowers, and I am the CEO and founder of VinMinder, a RegTech firm that specializes in this important area. In today's session, we'll cover details of the regulatory guidance and how they impact you as a board member, your role in ensuring compliance, and finally, why this topic should remain top of mind at every board meeting. As a board member of a regulated financial institution, it's important that you understand the new regulatory expectations when it comes to third-party or vendor risk management. The foundations of those expectations were thoroughly laid down in previous regulatory guidance, specifically Bulletin 29 of 2013, issued by the OCC 4 years ago. However, in January of 2017, the OCC issued Bulletin 7 of 2017, a supplementary examination guide on third-party risk management. This latest guidance is 22 pages long, and the Board of Directors is mentioned 20 times. The intent of the new guidance is quite obvious, and therefore a document you should read carefully, even if you're not an OCC-regulated bank. The OCC typically sets the standards for which all other regulatory bodies follow suit. Both documents, Bulletin 29 of 13 and Bulletin 7 of 17, go into very specific detail as to what the board and senior management are expected to know. The message is clear. Setting the tone from the top is not enough on its own. The guidance stresses the need for your active involvement as directors. I'm going to read a paragraph from Bulletin 7 so you can see how very specific it is. Quote, "The bank's board of directors or board committee and senior management are responsible for overseeing the bank's overall risk management processes. The board, senior management, and employees within the lines of business who manage third-party relationships have distinct but interrelated responsibilities to ensure the relationships and activities are managed effectively and are commensurate with our level of risk and complexity, particularly for relationships that involve critical activity." End quote. That language makes it crystal clear what the expectations are from a regulatory perspective. I think prior to that, there was a lot of confusion as to how often and how much information should be given to the board, or what most senior managers should be expected to know. The new guidance makes it explicit that both parties need to be actively involved in the business relationships of the financial institution. Bulletin 7 lays out point by point what the board and senior management are supposed to do. While this most recent guidance does not emphasize the senior management team as much, referring to it more generically as just management, it does, and let me emphasize this carefully, it does stress the need for active involvement at the board level. In fact, the board's responsibility is mentioned in nearly every section of the supplemental examination procedures. Let's go a little deeper into the OCC guidance. The first thing the board is supposed to do is ensure an effective process is in place to manage the risks associated with third-party relationships. Is the third party complying with the bank's standards? And second, are their activities consistent with what the bank expects from a risk management standpoint? Are the products and services complementary to the bank's other products? And how do you handle these issues at the board level? The board also has the responsibility to approve the bank's risk-based policies that govern the third-party risk process and identify critical activities. At a minimum, you should review the policy annually and/or when guidance changes, when you've received audit recommendations, or just to ensure you are following industry best practices. For example, the issuance of the most recent guidance was the perfect trigger to pull out your third-party risk management policy and look for any gaps between your current policy and the new guidance. Hopefully, your management team has already begun that process. Next is the board's responsibility to review and approve management plans for using third parties that involve critical activities. Use of the word critical here was very deliberate. Critical third parties are obviously ones that are fundamental to the mission of the overall performance of the bank. So, critical third parties require extra attention and deliberate scrutiny. For example, the guidance is clear that you must clearly document exit strategies and termination plans for critical vendors. The reason should be obvious. If a third party goes out of business, you want to make sure it's not going to harm the bank, your customers, or the customer's data somewhere down the road. The guidance even addresses some of the management reporting requirements to the board. as the supplemental exam guide released in late January spells out, you need to be able to show that the board was involved, whether it's through minutes of meetings or the actual presentation delivered at the board meetings. As part of the OCC's expectations for board oversight, Bulletin 29 of 13 says, and I quote, "Review summary of due diligence results and management's recommendations to use third parties that involve critical activities." Your management team needs to define a process for recommending to the board the selection of any new third party that is going to provide a critical activity. This should always be included in their monthly reporting package to you. To complete the documentation process, you will want to be sure it's acknowledged by inclusion in the minutes of your meetings. It needs to be that obvious. By the way, if the bank is making any exceptions to its policy, you absolutely need to be specific about that and highlight it each step along the way in the documentation. Next up, approving contracts with third parties that involve critical activities. This one expectation is probably the most controversial one of all. What the guidance is really saying is, before management can embark on a new critical third-party relationship of any type, the decision needs to go all the way to the board of directors for approval. It's not uncommon to get a lot of pushback on this one from management. Your management is likely to say, "We really don't think this requires our board's approval to bring on a small, new, critical third party." But imagine if you just changed payroll providers, an obvious critical third-party relationship. In this case, that contract would have to go to the board for approval before it is executed. Why would you want to do that? Because if you empower the front line to just sign up a new, highly important vendor without engaging the board, how can you be sure that there was good risk governance applied to that decision? The contract needs to reflect the critical role played by the vendor, including any new due diligence for any ongoing monitoring requirements. That's pretty fundamental, but it's not always top of mind at the business line level. Business managers are more likely to focus on ease of use and price. Your job is to ensure that any risk concerns for this type of vendor have been adequately addressed. We're not saying that every vendor contract must come to the board for approval, just those for critical services. The next item under board level requirements is to review the results of management's ongoing monitoring of third-party relationships. Again, this needs to be part of a standard reporting package to you from management. But the board's responsibility doesn't stop there. The guidance also dictates that you must ensure management is taking appropriate action to remedy any significant deterioration in performance. This pretty much falls into the no-brainer category. If something's going on with a critical third party and they're falling apart, you absolutely want to make sure that senior management and you are involved. Also, you should be seeing all independent reviews of your bank's third-party risk management activities. This would include any audit reports pertaining to your third-party vendors, as well as any audit reports focused on your third-party risk management process. In more concrete terms, what does this really mean? A prudent first step is to develop and implement the bank's third-party risk management process. Management really needs to set the tone as well as drive the responsibility to determine who, day to day, is the functional owner of the process. Then, establish the bank's risk-based policy to govern the third-party risk management process. What that really means is that everything is being executed in a consistent manner. Make sure that the role of the third-party vendor and the role internal audit is playing is consistent in their oversight of the third-party process. You want to make sure that day to day, the managers are doing things in a manner consistent with any other compliance activity. Let's move on to the next item. Developing a plan for engaging third parties, identifying the critical activities, and presenting that plan to the board. It's important to make sure that everything is clearly documented so that there are actual standards in place prior to a contract being executed. This is different from the item we discussed previously, where contracts for critical activities come to you for approval. This item simply puts a process in place for all other third-party contracts for management to follow. A thorough due diligence process needs to surround any decision to engage a new third-party vendor, and those results should be presented to the board when making any recommendations. While it is important to have a sound due diligence process in place, it can be challenging to execute. We see it all the time. Your people are busy and they want to just go forward with a contract without the added time of going through all the due diligence steps. There's pressure from the third party to sign, and there's business that needs to get done. But you can't afford to take shortcuts with due diligence. A lack of discipline here can have way too many unintended consequences to articulate in this session. The next item, establish the responsibilities of frontline managers for vendor oversight and include these in their annual performance goals. The new guideline does not emphasize senior management as a defined term, but it does mention management and board involvement repeatedly. So while accountability for third-party risk management ultimately lies with the board, it is incumbent on all levels of management to be involved and have a clear path for escalating items to the board. The board must set the tone from the top and hold management accountable to ensure the third-party risk is being managed effectively. The board also needs the ability to terminate arrangements with third parties that do not meet expectations or no longer align with the bank's strategic goals, objectives, and risk appetite. Nobody wants to go into a relationship thinking about how they're going to get out of it, but without a defined exit strategy, you could find yourself stuck in an auto-renewal status situation and miss the opportunity to exit when you need to exit. Make sure there is specific language that clearly defines how the third-party contract can be terminated without a large cost to either the bank or the vendor, and see that it can be done in a reasonable, prudent manner that does not expose your bank to additional risk. If you're signing on a new critical relationship, you want to have a specific section in the contract that identifies what the steps are for termination and what the steps are for an exit strategy. An exit strategy could be either a gradual winding down of the relationship over, say, a 90-day period, or it could address a more catastrophic scenario where the vendor either unexpectedly goes out of business or for some other reason you need to terminate the relationship immediately. What would that mean from a day-to-day standpoint? How should the bank react? And what steps is it required to take? What steps is the third party required to take if it's still a going concern? And most importantly of all, what happens to the customer data if there's customer data involved? Where does confidential information go? And how do we ensure that it's not compromised even after the termination of the relationship? This circles back around to my earlier comments about why the board needs to approve contracts with critical vendors. Without the proper provisions, you'll find yourself in a position of not being able to terminate a relationship when a risk assessment dictates that it needs to be done. The board also should make sure that the standards the bank has in place for third-party risk are consistent with what you deploy for credit risk, client risk, and any of the other areas of risk around the bank. It really helps if it's a level playing field. The board, senior management, and business line managers should all understand exactly what they're supposed to do day to day in terms of managing third-party risk. I'd like to spend the next few minutes on the section of guidance that addresses the requirement that periodic reviews be conducted of all third-party relationships that involve critical activities. The OCC guidance was the first to really emphasize that third-party risk management is an ongoing life cycle event and not just a point-in-time snapshot taken at the beginning of a relationship. Instead, it needs to be done on an ongoing basis for all third parties, not just the critical ones. The 2013 Bulletin and the more recent Supplemental Exam Guide are quite prescriptive in terms of what is expected at each stage of the life cycle of the third-party relationship. It can get quite challenging when you imagine the workflow process, particularly if third-party risk management is a small, isolated area within the compliance world and doesn't get the attention and resources it needs. That's where the board can help. You can ensure that adequate funding has been allocated to support third-party risk management. That can take the form of internal resources with full-time employees or outsourced resources to fill subject matter expert gaps and/or software applications to manage, organize, track, and report. For you, the most important thing to keep in mind is that third-party risk management is not an optional activity, nor is it a checklist activity. You must clearly demonstrate to examiners that third-party risk is being assessed, understood, and managed. It takes budget dollars to do that. A lack of adequate budget can, and likely will, result in examination findings that are much more expensive to remediate than if sufficient funding to avoid those findings had been provided in the first place. As a side note, we're seeing written examination findings on third-party risk being issued with greater frequency than ever before. And in most every case, they could have been avoided if adequate resources had been allocated to hire the help needed, be that internally or through use of an external provider with the right kind of expertise. But let's not forget the real reason why it's important to devote adequate resources to understand and mitigate risk. It's not just to stay out of hot water with your examiners. Managing third-party risk is essential to protecting the bank and your customers. What if a critical vendor goes down and you can't open your doors? What if a critical vendor is hacked and your customer data is exposed? Those are two real-life examples of catastrophic events that could have been avoided by simply doing all the proper oversight to identify specific risks for any particular vendor, developing a plan to mitigate those risks, and providing the program with sufficient funding. Anything short of that is really risk management malpractice, which ultimately will become your responsibility. The OCC guidance on third-party risk management was mind-numbing when it came out in 2013 because it really put banks on notice that they had to take it seriously. It not only caught the attention of national banks supervised by the OCC, but also state banks governed by the FDIC and the Federal Reserve, which eventually issued similar guidance on their own. Most banks seem to be gravitating towards Bulletin 29 of 13, which now incorporates Bulletin 7 of 17, because it gives the examiners a playbook for how to assess all the important elements of a third-party risk management program. Together, the two bulletins re-emphasize the need for prudent third-party risk management, while also providing some much-needed detail on what the examiners will expect come exam time. What guidance should you be following? You need to understand what your prudential regulator emphasizes, of course, but I would caution you against dismissing the OCC guidance if you're not an OCC-regulated institution. Regardless of who your primary regulator is, follow the guidance that ensures you have the most robust program possible to ensure that risks associated with outsourcing key portions of your financial institution's business are kept firmly in check. Following the OCC guidance will leave no doubt in your ability to do so. Ultimately, it's the board's responsibility to make sure that all third-party relationships are handled in a safe and sound manner. As we bring this video to a close, let's summarize some of the key board responsibilities for third-party risk management. Ensure that an effective process is in place to manage the risks associated with third-party relationships. Is the third party complying with the bank's standards? And are their activities consistent with what the bank expects from a risk management standpoint? Approve the bank's risk-based policies that govern third-party risk processes and identify critical activities. At a minimum, you should review the policy annually when guidance changes, when you've received audit recommendations, or just to ensure you're following industry best practices. Review and approve management plans for using third parties that involve critical activities, and also approve all contracts with third parties that will be providing critical activities. Review the results of management's ongoing monitoring of third-party relationships. And establish the responsibilities of frontline managers for vendor oversight and include these in their annual performance goals. Finally, have the ability to terminate arrangements with third parties that do not meet expectations or no longer align with the bank's strategic goals, objectives, and risk appetite. Thank you for joining me for this online training series video on vendor risk management.